It's hard to imagine what life was like without easy access to consumer credit. Whenever I fly off on a trip, all I really need is my driver's license and a credit card. On a recent vacation in Mexico, my trusty credit card saved the day when my wife broke her ankle on New Year's Eve. Easy access to credit makes life a lot easier, but as many have discovered, easy credit can also make life a lot more difficult. How do we use credit optimally? If you think back to the lecture on life cycle finance, you'll recall that the right time to use credit is when our current income falls below our lifetime average income. So the sensible times to use credit are when you're young and when your income is going to rise in the future, and when we also have a temporary drop in income. This is where an economist butts heads with a lot of financial gurus. Many of those gurus will tell college students that they shouldn't go into debt, that they should avoid using credit cards, and that they should focus instead on saving instead of borrowing. An economist would say that you have to weigh the added joy you get from spending more today by using credit against the loss in joy from having to pay it back in the future. One reason that the financial gurus might be right about avoiding credit when you're young is that many of our credit habits stick around for a long time, long after we should have switched from borrowing to saving in the life cycle. Once we get used to maintaining a credit card balance, we may never pay it off, paying thousands of dollars in interest and penalties over time. Irresponsible use of credit is often the result of bad habits. And it's these bad habits that keep the profits flowing to banks that issue the credit cards. In this lecture, I'll introduce strategies for those who have trouble dealing with credit. And I'll tell you how to get the most out of borrowing tools like credit cards and consumer loans. Everyone needs to understand some basics about credit scores, since a bad score can ruin not only our ability to get a car loan or a mortgage, they can affect our ability to get insurance or even a job. Let's start by talking about credit cards. The first thing you need to know is that credit cards are issued by a bank. The bank makes money from charging you interest in the outstanding balance of your credit card debt, fees for things like late payments, and an interchange fee. The interchange fee is about 2% of every charge you make, and it's paid by the merchant. So when you spend $100 at a restaurant, the business gets $98 and the bank gets $2. The bank then pays part of this back to the credit card company. Americans spend about $1 a day on interchange fees, and that money shows up in slightly higher prices paid at businesses. You might wonder why there isn't more competition among banks to lower these fees. In fact, there is. About half of the fees are rebated back to consumers through reward cards. These can include a cash percentage of each transaction paid back to you at the end of the year, or points towards gift cards, hotels, or airline travel. The second way these fees are paid back is through incentives to sign up for credit cards. A savvy shopper can get between $500 and $1,000 of value for signing up for a reward card, and then get a rebate on interchange fees that can add up to hundreds of dollars per year. While Americans spend about $30 billion each year on interchange fees, as of April 2014, they carry about $850 billion in credit card debt. This means the average American household has $7,000 in debt on their credit cards. Since most households don't have any credit card debt, households who do have debt owe an average of $15,000. The average interest rates on credit card debt are a little more than 13%. That means that Americans pay about $115 billion in credit card interest every year, or about $2,000 a year for every household that carries credit card debt. If you're one of the Americans who carries a balance on your credit card every month, I want you to understand the choice that you're making. Let's say you have something close to the median credit card debt, which is about $5,000. At a 13% interest rate, you'll pay $650 a year in interest to the bank. Over a 30-year working life, that means you'll pay about $20,000 in credit card interest. If you paid off your $5,000 in debt and instead invested the $650 a year in your 401k, you'd have an extra $43,000 at a modest 5% rate of return. Carrying credit card debt is costly, and it can sabotage your long-term goals. Why do we carry credit card debt? As I mentioned in my discussion of behavioral finance, many people suffer from narrow framing. We tend to see our investment accounts as existing in a world that is separate from our credit card. But the truth is that we may be investing in a bank in our investment account, earning 1% interest, while at the same time borrowing from the bank at 13% interest. We're borrowing our own money and paying 12% to the bank for the privilege. Financial habits can be very powerful. If we find ourselves in the habit of carrying a credit card balance, we often think that at some point in the near future, we'll become more responsible and pay it off. We assume that we'll behave more responsibly in the future than we do today. Then the future comes, we get tempted by the same things that tempted us yesterday and fall into the same spending habits. Understanding our habits can help us develop the tools to break them. If you have enough liquid and investment assets to pay off your credit card debt, then do it. But understand that you'll probably rack those debts back up in the future if you don't change your habits. An easy solution is to simply reduce your credit availability. Limit yourself to 1 or 2 credit cards and phone up your bank to reduce the spending limit on each. Then phone up the other credit card companies and cancel your cards. One method for reducing unnecessary spending is to make each much more salient. A psychological problem with credit card spending is that it insulates you from the financial trade-off you make when you buy something. If you spend $200 on a pair of shoes with a credit card, the cost doesn't seem that real. But if you have to pay in cash, handing over $10, $20 bills is far more salient. Experimental studies show that buyers who pay in cash aren't as willing to pay a higher price for goods and are better able to imagine the other things they could have bought with that money. A powerful personality trait related to the misuse of credit is impulsiveness. Are you the kind of person who changes hobbies or jobs often? Do you make up your mind quickly and act on the spur of the moment? Or do you plan tasks carefully, like thinking about deep problems and about the future? I often find myself on the higher end of the impulsiveness scale. Many of you probably are too. It's not necessarily a bad thing, but it can harm your long-run goals. If you think you might be impulsive and find yourself with more credit card debt than you like, then you're much more likely to dig yourself out of the hole by working around your impulsive tendencies. Reducing available credit card balances, paying in cash, sleeping on a big purchase, and avoiding tempting shopping malls or the internet all can help you avoid spending on impulse. If you don't have enough money to pay off your credit card debt, then develop a plan for reducing debt every month. Use the same strategies I just talked about to reduce credit availability and avoid impulsive spending. One problem is that we often don't have space in our budgets to make that payment this month, so we're tempted to wait until the next month to write that check. This is where we can use salience to our advantage again. A good strategy is to set up an automatic payment from a checking account to the bank every month. If you have $5,000 in debt and a goal of paying it off over 2 years, estimate the payment you'll need to pay off the debt and have it automatically withdrawn from your account. If you have it withdrawn the day after your paycheck is deposited, you may never notice that the money is gone. We all have a tendency to match our spending to our budget, so reframing the budget through the automatic withdrawals can be a useful strategy. Since 2007, more money has been spent on Visa debit cards than on credit cards. The popularity of debit cards may seem like a mystery since they don't have many important advantages of credit cards. There are no rewards, you don't receive a free float between when you spend the money and when you pay it back, and your checking account balance might disappear if somebody steals your card. If you're just starting out, using a debit card also won't help you establish a credit history. As we'll talk about later, a responsible credit history is an important part of your credit score, and you'll need a good credit score to get a home or a car loan later in life. The good news about debit cards is that you don't have to pay the high interest expenses on a credit card balance. Debit cards draw money immediately out of your bank account. You can't spend more than you have, so debit cards avoid some of the behavioral pitfalls that many credit card users experience. That behavioral benefit helps, but the biggest reason for the growth in debit cards is the popularity of its use among those with bad or no credit who may not be able to get a credit card. Today, it's a lot more convenient to pay with a card than with cash. There's no buying stuff on Amazon with cash. That's why prepaid cards have also become very popular. Should you have a debit card? A credit card trumps debit cards for people who pay off their balance every month. They give you rewards and a free loan of up to a month before you have to pay off your credit card bill. But they also provide a means for those with self-control problems to dig themselves into a credit hole. If you can't get in the habit of paying off a credit card balance in full every month, then a debit card gives you convenience without temptation. If a credit card is right for you, what should you look for when shopping for one? That depends on whether you're a convenience user who doesn't carry an outstanding balance or if you have revolving credit card debt. Convenience users should focus on interchange fee rebates and incentives to sign up for a card. If you can get a $500 flight and 1% cash back, then go for it. If you don't have a rewards card now, get one. Most will also provide services including buyer protection, rental car insurance, even concierge travel services. Pay attention to annual fee costs on the cards to get the most generous deal. If you do carry a balance, then you need to pay attention to annual interest rates. And if you haven't set up automatic bill payments, then pay attention to grace periods and past due fees. Also, avoid cash advances on a credit card. They have a higher interest rate, and interest begins the day you take out the money. There's no float or grace period. And if you buy chips in Vegas using a credit card, that's a cash advance, so your bank account's hangover might be even worse than you expected. Since a credit card provides what's known as an unsecured credit, the lender has fewer options if you don't pay them back. Secured credit gives a lender the option to repossess property to get some of their money back. For this reason, secured credit is going to have a lower interest rate than unsecured credit. Examples of secured credit include a car or a home loan. If you're serious about paying off a high interest rate credit card balance, then taking out a secured loan to pay off a credit card balance can make sense. One final note about credit cards. If someone steals your card, the limit of your liability is $50. A lot of people don't feel comfortable using credit cards online because they're afraid someone's going to steal their credit card number and rack up a bunch of charges. If it happens, phone up your credit card company and let them know. If you haven't done it already, take all the credit cards out of your wallet right now and make a photocopy of them. Stick it in a safe, and you'll always know the card numbers in your wallet if your wallet gets stolen. You shouldn't feel insecure about making online payments with a credit card in general. The most significant sources of consumer debt are student loans and mortgages. I'll cover those topics when I discuss education and housing. Other than credit cards, the next largest source of consumer debt is a car loan. There are two basic types of car loans. A standard car loan is a typical amortized loan where your payments consist of interest and principal. Principal is just the amount of money that you borrow, and you chip away at it over time with your car payments while paying interest for the privilege of borrowing. Equity is the difference between a car's current market value and the remaining principal on the loan. You can think of equity as your stake of ownership in a car, or the percentage of the car that belongs to you. New cars tend to drop in value quickly during the first year of ownership. This drop in value is known as depreciation. At the beginning of the loan, the interest part of your payment will be really high because you still owe a lot of money on that car. This means that after a year of ownership, you may have very little or no equity. Negative equity is known as being underwater. When you try to trade your car in, it essentially has a negative value towards the new car. Equity tends to become positive towards the end of a loan. It's always a good idea to shop around for a car loan. Start with your local bank or credit union. Your interest rate will depend on your credit rating and whether you're buying a new or a used car. You may also finance your car at the dealership, but financing rates at the dealership can be uncompetitive and are often a source of profit for the dealer. Occasionally, you can get a very low rate that is subsidized by the manufacturer to help them move a slower-selling car. But you have to compare the low rate against other possible price discounts. It may be a better deal to take the price discounts and finance through your own bank. You'll also need to decide how long the car loan is going to last. You can often get a lower interest rate by paying off the car in 3 years instead of in 5. In general, interest rates on car loans are higher than interest rates you can get on liquid savings. So you're better off paying the loan than putting the money in a checking account. If there is no difference in the interest rate between a shorter and a longer loan, it's best to take the longer loan since you always have the option of paying more than the required payment to reduce the length of the loan. The biggest mistake people make buying cars is being impulsive. They often wind up at a single car dealership and both buy and finance a car the same day. This means that the price they pay is often higher than the price they could have gotten from shopping around, and the loan terms are often less attractive. Being methodical about shopping around for the best price and the best loan terms can have a big payoff. It's certainly worth a day or two of your time to shop around. The second mistake people make is to focus only on the car payment and not on how much they're paying for the car and what the real interest rate is. Don't go to a car dealership without some idea of the loan terms you can get from a bank, including the down payment, interest rate, and the length of the loan. When you're comparing loan terms to a dealer's financing offer, make sure you're comparing loans of the same length. And don't let a really generous trade-in offer take the focus off the price and the interest rate that you're going to be paying on your new car. The second way to borrow money for a car is through a lease. With a lease, you do not own the car after the loan is finished. The lease allows you to make a lower payment that only covers the expected cost of depreciation on the car. It is possible to get a lease from either a car dealer or from a lender that's unaffiliated with a dealership or the car manufacturer. An easy way to think of a lease is that it has a defined start and end date, say 3 years. You have a price that you pay for the car and a value of the car at the end of 3 years when you return the car to the leasing company. This value is known as the residual. It's usually set as a percentage of the price of the car. If you're thinking about leasing a car, look at an online table of residual values for different cars. Since you're paying for the difference between the price today and the value in 3 years, then the lease payment will be lower if the car will be worth more in 3 years. Higher residuals make cheaper leases. Since you'll be borrowing money to pay for the difference between the purchase price and the residual value, you'll have to pay some interest. Interest rates on leases are weird. The finance guy will call it a money factor, and it's usually a really low number, like 2.5. To translate the money factor into an interest rate, just double that amount. So if they quote you a money factor of 2.5, the annual interest rate is about 5%. The most important thing to remember about leasing is that you'll be paying for the most expensive years of ownership of that car. A car depreciates the most in the first year, and a little yet less each year after that. A mistake that many people make is getting on a treadmill of buying a new car every few years and suffering most of the depreciation, and then handing the car over to a second owner who pays a lot less each year to drive it. Continually leasing cars means that you'll always be driving a new car. This is fun, but it's also very expensive. The possible exception is when car companies try to get rid of slow-selling cars through artificially low lease payments. Instead of cutting car prices, a car company can increase the residual, or the value of the car when you trade it in 2 or 3 years. Since you only pay for the difference between the price and the residual value, this can lower payments significantly and might be an attractive alternative to buying a car. For example, let's say Toyota is offering a lease of $200 a month on a small SUV. The purchase price on the lease is $22,000, and in order to get the payments down to $200, they assume that the car's value at the end of the lease is $17,000. This residual value of $17,000 is probably more than the car is going to be worth in 3 years. But it lets the car company sell inventory without having a fire sale. If this happens, just make sure you stay within the mileage specified in the lease terms and don't fall in love with the car and buy it at the end of the lease. One of the most important determinants of whether you'll be able to get a competitive interest rate on a car loan or a credit card is your credit score. A credit score can also affect how much you pay for car insurance and even whether you get a job. An investment in a good credit score can pay off by reducing loan and insurance payments by thousands of dollars over a lifetime. A credit score is not the same thing as a credit report, so let me differentiate between the two. A credit report is a detailed listing of your prior credit experiences. Which credit cards you've owned, what the credit card balance is, whether you've paid them off. If you haven't looked at your credit report recently, the good news is that you can access it 3 times a year for free. Just go to annualcreditreport.com. Do not go to any other site to check your credit report. Annualcreditreport.com is free and has no strings attached. They also don't make money, so they can't pay for the funny commercials. Don't go to that site. Check over the accuracy of your credit report. The reason you get 3 free credit reports is that there are 3 primary credit reporting bureaus that provide information to lenders: Experian, Equifax, and TransUnion. Get 1 report from each. There may be some inconsistencies among reports because of inaccurate information, so be sure to compare them. If you find any problems, you can dispute the data, and the credit bureau must respond within 30 days. Now, when you apply for a loan, the lender won't look at your credit report. They'll use a number that's calculated from what's in your credit report. That's your credit score. What's the purpose of a credit score? The score is supposed to represent the likelihood that you'll default on a loan. Is it accurate? Academic studies show that credit scores do a good job of predicting default. In fact, the existence of accurate scores means that more loans can be made to borrowers with good credit scores because lenders know they probably are going to pay it back. It also means that higher risk borrowers pay a higher rate of interest. This may not be equitable since many high-risk borrowers also have low incomes, but it is an efficient system that gives lenders the ability to make profitable loans to high and low-risk borrowers. The credit score is also called the FICO score, or Fair Isaac Corporation. FICO scores are not free. Only the credit report is free. Getting your FICO score through myfico.com is going to cost you $20 for each of the 3 credit reporting companies. It's probably worth checking out your score to see whether you're eligible for the lowest interest rates on a loan before you shop for a car or a house. The credit score is composed of 5 factors. The most important is credit history. If you've been late on a payment, defaulted on a loan, declared bankruptcy, or had a car repossessed, then you're going to have a lower credit history score. Some actions are worse than others. Obviously, declaring bankruptcy will have a big impact on your credit score for the 10 years that it appears on your credit report. The second most important credit score factor is your debt. According to FICO, the purpose is to determine if you're overextended. They'll look at how much debt you have in different accounts and how much of the available credit you've used up, also known as the credit utilization ratio. A little bit of debt is okay, but once you start using up all of your available credit options, they start wondering whether you're getting close to a default. These 2 factors make up 2/3 of your credit score. There are 3 other characteristics that make up the rest of the score. The first is your credit history, which consists of the average age of your loans and the age of your oldest loan. This is also one of the reasons you should establish a credit history early in life so that you can show a record of on-time payments and can have some older credit sources before you begin shopping for your first mortgage or a car loan. The second is how many different types of credit you have. Obviously, having more, say a mortgage, credit cards, and a car loan, is better from a lender's point of view, since it demonstrates your ability to handle debt. Last is the number of times a lender has recently searched your score for credit. Too many times might be an indication that you're fishing for a lot of additional credit. But shopping around for the lowest rate on a car or home loan won't have an adverse impact on your score. And any credit searches go away after a year. Bankruptcy will torpedo your credit score. Like any other financial choice, the decision to declare bankruptcy means weighing the consequences. There are 2 types of consumer bankruptcy. Chapter 7 is for folks that do not have significant assets. Those who do and who want to protect those assets, like a home and retirement account, can choose to file for Chapter 13 bankruptcy if they can repay their debt over time. Chapter 7 is like starting over, and Chapter 13 is like getting a breather. What happens in bankruptcy? In Chapter 7, all of your unsecured debt goes away. All of the credit card and medical bills are discharged, but you still have to pay student loans and IRS debts. Declaring bankruptcy involves some cost and may be significantly expensive if you declare Chapter 13. You'll have to consult with an attorney in most cases. The decision to declare bankruptcy should be considered a strategy of last resort, but many economists wonder why more people who suffer under the burden of heavy debt and few assets don't go through the process. Other than a loss of credit, many feel that bankruptcy is a personal failure. But it can be a reasonable option for reaching long-run goals for those who've fallen too far behind. Credit gives us spending flexibility and convenience. It can also be a temptation that prevents us from reaching our long-term goals. Making the most out of credit means understanding how the consumer credit system works, but it also means being aware of our own limitations.